Welcome to Dinar Community, your trusted source for in-depth coverage and strategic insight into global currency developments that are often ignored or sidelined by mainstream outlets. Today's discussion isn't based on gossip, guesswork, or unverified social media noise. What unfolded across the foreign exchange (FX) landscape was no technical mishap. It wasn't a software bug or a data hiccup. It was a precisely coordinated event, intentional, impactful, and possibly historic. What we witnessed with the Vietnamese Dong (VND) wasn't the result of panic or market overreaction. It was what some financial insiders are now calling strategic ignition. This isn't about economic collapse or wild inflationary spirals. It's a sophisticated, premeditated move to recalibrate a long-suppressed currency. This wasn't leaked in chat rooms or foreshadowed by institutional whispers. It arrived without warning, and it hit hard. At exactly 8 a.m. GMT, a series of synchronized FX freezes rippled across the financial capitals of Singapore, Frankfurt, London, and New York. Traders initially thought it was a network issue, a data lag, or a temporary error. But the reality quickly became clear. The global foreign exchange infrastructure was locking up, and the epicenter was the Vietnamese Dong trading against the U.S. dollar. What followed was a flood of rapid buy orders targeting VND. Automated systems collapsed under the pressure. Risk models failed, algorithms tripped circuit breakers, and trading platforms across continents froze as order books overloaded. The situation grew even more concerning when internal memos began circulating in major investment firms, demanding complete silence on the Vietnamese Dong. No public speculation, no internal analysis. Just a blackout. Why? Because this wasn't random, it was calculated. The trades were surgical, executed in tight intervals and backed by resources and precision only available to elite institutions, possibly operating with insider knowledge or quiet support from regulatory powers. And then, almost simultaneously, sources in Vietnam confirmed something even more explosive. Classified financial documents from the Vietnamese Ministry of Finance had been leaked. These materials outlined a phased and carefully constructed revaluation strategy for the VND, not just domestically, but aimed at increasing Vietnam's standing in the global financial hierarchy. Details from the leak revealed alignment plans with BRICS trade protocols, updated gold reserve positions, and private negotiations with key Asian and global economic powers. This wasn't theory, it was strategy in motion, backed by internal economic modeling that reportedly began over a decade ago. The timing of the event, coinciding with the cross-market overlap of European, Asian, and American trading hours, confirmed the coordinated nature of this ignition. This was no accident. It was a systemic stress test, an aggressive push to challenge the world's liquidity infrastructure and see who was prepared. Evidence suggests that pre-briefed institutional players moved early to take advantage, reaping arbitrage profits while retail and secondary markets lagged behind. This wasn't your average speculative spike, it was an institutional maneuver, built with intent. In the aftermath, select FX dashboards captured anomalous VND values, some as high as 1,500 or even 150 per USD, briefly appearing on internal systems. While central bank tickers clung to traditional figures around 23,000 per USD, off-grid platforms told a drastically different story. Vietnamese domestic banks suspended rate quotes altogether, foreign exchange counters shut down, and Ho Chi Minh City branches froze transactions entirely. Meanwhile, in Hanoi, the Vietnamese central bank entered crisis protocol mode, locking doors, increasing security, and holding unpublicized emergency meetings. This was not a meltdown. It was controlled escalation, clear signs of structured preparation for a long-anticipated shift. Was this a one-off, or the beginning of a larger reconfiguration? More analysts now believe this was just the beginning. The VND didn't behave like a meme asset or a bubble currency. It acted like the first stage of a broader currency recalibration. The VND may be the prototype, the test case, for a whole series of planned revaluations in emerging markets. 2025 could be remembered as the year Vietnam transitioned from an export-driven manufacturing force to a major monetary influencer. And this move may reshape how global finance treats underleveraged and undervalued currencies. The impact could stretch across Southeast Asia and beyond. If the VND shift holds, nations like Thailand, Indonesia, Malaysia, and Laos, which maintain similarly suppressed currencies, will be forced to respond or risk losing trade competitiveness. At the corporate level, CFOs worldwide will be recalculating forecasts, vendor contracts, and risk models. And in the shadows, a derivatives bomb may be ticking. Countless FX contracts and options rely on the stability of undervalued currencies. With VND breaking formation, many of those agreements may soon need to be renegotiated or settled. But the most dramatic shift may be ideological. For decades, the global currency reset (GCR) was dismissed as an online myth or conspiracy theory. Economists scoffed. Analysts rolled their eyes. But after the Vietnamese Dong's orchestrated disruption, even hardened skeptics are reevaluating their stance. This wasn't speculative frenzy, it was a systematic deployment of financial power. And now, even former critics of the GCR idea are beginning to admit, something real is happening. Whether this is the beginning of a GCR or a set of national-level realignments, the takeaway is clear: old rules no longer apply. If you've held Vietnamese Dong in quiet confidence, perhaps even facing ridicule from traditional financial voices, your patience may soon be rewarded. But this is not the time for passivity. Here's what holders should do immediately. Verify your holdings. Make sure physical currency is secured in sealed containers. Keep all documentation intact and ready for review. Be prepared for rapid changes. KYC and AML rules may shift without warning. Compliance standards will tighten fast. Watch for blackout exchange pauses. Some private currency dealers have already paused VND redemptions, pending regulatory updates. Also, look for subtle signals, language like market stabilization, currency monitoring, or regional FX alignment in public statements. These are your breadcrumbs. Pay attention not only to Vietnam's central bank but also to institutions like the IMF and World Bank. Terms like currency harmonization or red flags for revaluation planning. Another quiet but growing trend: private VND exchange offers under NDA. These should be approached with extreme caution. Some may be legitimate, others could be sophisticated traps. This is not just about the VND anymore. This could mark the beginning of a systemic FX reconfiguration. If Vietnam's strategy proves successful, others will follow, perhaps Iraq, Iran, or even African and Latin American currencies aligned with BRICS plus expansion. The window to act may be narrow. There won't be TV ads. There will be no loud announcements. You must be ready when opportunity knocks. At Dinar Community, we monitor these developments continuously, decoding insider chatter, tracking hidden market signals, and providing real-time, actionable intelligence. What just happened isn't the end, it's the first salvo in a financial war for influence. And if you're reading this now, you still have time to prepare. This is your call to readiness. Stay alert, stay informed, and most importantly, stay ahead. Because 2025 might be the year the world's monetary system begins its next chapter, with Vietnam leading the charge.